Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing ON stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 30 billion market cap. They're trading at $70 a share and they have 429 million shares outstanding. ON Semiconductor provides intelligent sensing and power solutions in the US and around the world. They have three segments: Power Solutions Group, Advanced Solutions Group, and Intelligent Sensing Group. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Free cash flow looked good in 21 and 22, 1.6 billion, their peak. Then it dropped a lot. It went down 75% in 2023, down to 400 million. It is up in the trailing 12 months to 600 million. And margins are getting pretty weak. They converted only 7% of their revenue into free cash flow in the trailing 12 months. It was close to 20% in 21 and 22. Net income is the profit or loss on the income statement. It's revenue minus expenses. That improved a lot from 1 billion to 2.2 billion. So net income is improving, free cash flow is getting worse. This implies they're investing more into CapEx. So that could lead to greater free cash flow in the future. Revenue is the sales for the company, and that looks okay. It goes from 6.7 billion to 8.2 billion, but it peaked in 2022 and it's gone down 1% after that each year. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 32 billion. We discounted those numbers back to today using a weighted average cost of capital. We get a value of the company of $28 billion. We divide that by 429 million shares. And we get a calculated stock price of $66. They're trading at $70, so they're trading at a 6% premium. It's a sell according to the model. So as you know, the stock market is perfectly efficient. That's why this stock is trading pretty close to intrinsic value. All news and information is priced into the stock market. With that theory, it's impossible to make money in the short term. You could only make money in the long term. There are 64 companies in the same industry as ON, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend a good amount in CapEx, 1.4 billion. So it looks like they're similar to Intel, where they're a fabless and a foundry. Debt to equity ratio is decent, 0.4. For every dollar of equity, they have 40 cents of debt. They're one of the few companies in this industry that does not pay a dividend. AMD does not pay a dividend, neither does ARM. Those are the only two companies in the top 15 that do not pay a dividend. Nvidia pretty much doesn't pay a dividend. It's close to zero. ON generates 600 million of free cash flow between the median and average. This should be blue. They rank 16th in market cap. I know some people were looking at ARM as a possible 10x or 100x like Nvidia. I don't think that's going to happen, but who knows? They're trading at 4 times book value, 14 times earnings, which is a really good PE. UMC has the best at close to 10. They're trading at 50 times free cash flow. They're not generating that much free cash flow because they're investing so much into CapEx. As we saw earlier when we looked at their financials, and this proves it right here, 1.4 billion. That's a lot for the size of the company they are. That's more than Nvidia, and Nvidia is 100 times the size. You heard that right, 100x ON. Because ON is 30 billion, 10x is 300 billion, and they're 3 trillion. They're trading at a little better than 4 times revenue, which is better than the median average. They generate a lot of revenue relative to their market cap. Look at STM, 16 billion of revenue. They generate the most revenue relative to their market cap. They have the best price sales ratio. And ON is still growing. Their 5-year annual revenue growth rate is 7%, better than the median average. I really need to work on my color coding skills. If you put $10,000 into ON 10 years ago, you'd be a happy camper at $80,000 today. At 1.2 years ago, you would have been at $110,000. But still, a 700% return is really, really good. Let's take a look at their latest 10Q. Here's their income statement. Revenue is down 2 billion to 1.9 billion. Let's see if they give a breakdown of the revenue. Here's a breakdown of the 1.9 billion. Revenue in Power Solutions Group, 870 million. Gross profit, 365 million. Analog and Mixed Signal Group, 700 million. Gross profit, 338 million. Intelligent Sensing Group, 300 million. Gross profit about 50%, 149 million, a little higher than 50%. They generate the most revenue in the UK, 440 million. The second most in Singapore, 433 million, then the US, 419 million, then Hong Kong. Those 4 countries are like 90% of their revenue. All other countries, 161 million. A little less than half their revenue is to distributors. That's lower margin because the distributor is the middleman. The distributor sells to the retailer. A little more than half their revenue is to direct customers, higher margin, 956 million. They sell a lot of chips that go into autos, 1 billion, industrials, 476 million, and other, 369 million. Autos are up, but industrial and other are down. Other is computers, consumer, networking, and communication. Here's a different breakdown of their revenue. Intelligent power, 950 million. Intelligent sensing, 360 million. Other, 546 million. Revenue is down 97 million from the first quarter of 2023. Cost of revenue is down 33 million. So gross profit is down 64 million from 917 million to 853 million. I wish they gave percentages. Dollar amounts are good information, but percentages are much better. R&D is up from 138 million to 150 million. That's their biggest expense. The second biggest is G&A, 95 million, then selling and marketing, 69 million. Amortization is 12 million. So total expenses, 328 million, down from 350 million. So operating income was 565 million, now it's 525 million. They spent 15 million of interest on their debt. Last year, a lot higher, 26 million. So their net income, 450 million, down from 460 million. Let's take a look at the balance sheet. Current assets, 6.1 billion. Current liabilities, 2.1 billion. So a really high current ratio, about a 3. Current ratio is current assets over current liabilities. Current assets are assets you can liquidate into cash within 1 year. Current liabilities are debts that are owed within 1 year. That's why it's such an important ratio to look at. They have a lot of cash, 2.6 billion. Their second biggest asset is inventory, 2.1 billion. And they give a breakdown of inventory, 450 million of raw materials, 1.3 billion of work in process, and 388 million of finished goods. Finished goods are ready to sell. Work in process is close to being ready to sell, but there's some work to do. Raw materials is much further away. So there are expenses involved to get it from raw materials to finished goods. So that's something to consider when analyzing a company. Their biggest asset is PP&E, 4.4 billion. They tell us where the PP&E is located. 1.5 billion in the US, 1.3 billion in South Korea. This implies they do manufacturing in these countries. Czech Republic, 570 million. Philippines, 240 million. China, 250 million. Malaysia, 200 million. Vietnam, 160 million. 153 million of other. I wonder what the other is. I feel like I'm losing my voice. I spoke so much on yesterday's video. It's a long video, over an hour. It looks like they do acquisitions, 1.6 billion of goodwill. Here's how they come up with the goodwill. Gross goodwill is 2.4 billion, and they break that down by segment, minus impairments of 781 million. That's how you get to 1.6 billion. A majority of their goodwill is in their category AMG. 13.5 billion of total assets, total liabilities 5.3 billion. They have 2.5 billion of long-term debt. Here's some more info on the long-term debt. A revolving credit facility due in 2028. The interest rate on that is 6.7%, 375 million outstanding. A $1.5 billion note with a really low interest rate, 0.5%, due in 2029. A 0% note, how do they do that? Due in 2027, 800 million. And a 3.875% note due in 2028, 700 million. So the gross long-term debt is 3.4 billion. The net is 3.3 billion. 800 million is current debt, 2.5 billion is long-term debt. I'll show you what I mean on the balance sheet. Here's the current portion of long-term debt, 794 million. That's debt due within 12 months. The long-term portion of long-term debt is 2.5 billion. That's due beyond 12 months. Assets minus liabilities equals equity, 8.1 billion of equity. They raised 5.2 billion from selling their business. They profited 7 billion from running their business. And they buy back a lot of stock. They bought back 4.1 billion of their own stock. Treasury stock is a contra equity account. It brings down your equity balance. So when a company buys back their own stock, they carry it on the balance sheet as treasury stock. Because when a company buys its own stock, its cash goes down, the cash goes down, and their equity goes down. When they issue more stock, cash goes up, the cash goes up, and equity goes up. Let's look at a statement of cash flows. The first section is operating cash flow. That went from 400 million to 500 million. That looks good, 500 million of operating cash flow. And the way you calculate that, you take your net income of 450 million, you add back depreciation of 150 million, you add back stock-based compensation of 33 million, and you have to adjust for changes in working capital. It looks like they bought 36 million of inventory. That's a cash outflow, and some other things. The reason their free cash flow is low is because they're spending a lot on PP&E, 222 million in this quarter. Last year they spent 320 million, so they only had 80 million of free cash flow, 400 million minus 320 million. This year, 276 million of free cash flow. Let's look at the financing section. It looks like they give their employees stock because they paid 37.5 million of taxes on restricted stock units. They bought back 100 million of stock. So in their financing section, they had a cash outflow of 131 million. The cash at the end of the accounting period is 2616.7. And if you go to the balance sheet, it's 2614.4. Why is it different? It should be the same. Well, let's go back to the statement of cash flows. They reference note 4. So let's go to note 4. Here's the 2614.4 that matches the balance sheet. The difference is restricted cash of 2.3. That 2.3 is included in other current assets. So they actually have 2.616.7 of cash, but it appears lower on the balance sheet because the restricted cash is in other current assets. Interesting, right? Let's take a look at their first quarter presentation slides. First quarter 2024 highlights: exceeded expectations in a challenging environment. Wow, they exceeded expectations. Gross margin of 46%. I think Nvidia is like 70%. But I like to invest in companies north of 50%. But that's compared to 30% in prior downturns. I guess we're in a downturn. Free cash flow increased 3x year over year. Vehicle electrification revenue grew 60% year over year. They supply semiconductor chips to EV companies. They return 100% of latest 12-month free cash flow to shareholders through buybacks. They do not pay a dividend, but they do buy back stock, which I think is better than a dividend payment. What do you think? They grew revenue 9% year over year. Revenue for the quarter, 1.86 billion, down 5%. Gross margin 46%, down 90 basis points. 100 basis points is 1%, so it's down 0.9%. Operating margin 29%, down 3.2%. Diluted EPS 108, down 11 cents year over year. So that means it was 119 last year. Last 12-month free cash flow 7.2%, up 2.3% quarter over quarter, not year over year. When it says quarter over quarter, that means it's comparing 12/31/2023 to 3/31/2024. When it says year over year, that means it's comparing 3/31/2024 to 3/31/2023. Automotive revenue 1 billion, up 3%. Industrial down 14%, a little under half a billion. Other revenue down 12%, 369 million. Here are some of their big announcements. onsemi releases DC ultra-fast EV charging solutions. DC stands for direct current. That's a type of power batteries use. If you have a Tesla, you probably use AC charging at home. AC is alternating current. That's good for overnight charging. But if you stop at a charging station on the road, you want it to charge really fast. So they use DC. Some DC charging stations can charge a battery in as little as 30 minutes. To get into the technicals a little more, a DC charger has the converter inside the charger itself. An AC charger does not. That means it can feed power directly to the car's battery and does not need the onboard charger to convert it. That means DC chargers are bigger and faster, which is a huge breakthrough for the EV market. The DC charging market was valued at $67 billion. The projection for 2030 is $220 billion. There are probably close to 40,000 publicly available DC fast chargers in the US. So the ratio is about 70 vehicles per charger. onsemi also introduced the 7th gen IGBT-based intelligent power modules to reduce energy consumption in heating and cooling. That stands for insulated gate bipolar transistor. And the third biggest announcement is onsemi aligns business groups to expand product portfolio and accelerate growth. Lots of buzzwords in that sentence. Here's their guidance for second quarter. Revenue around $1.7 billion, close to $1.8 billion on the high end. Gross margin about 45%, OPEX about $335 million, and EPS about 85 to 90 cents. Revenue last year in the second quarter of 23 is $2.1 billion. So their projection is a lot lower, $1.7 billion. They keep losing market share to the bigger companies like Nvidia and AMD. The total addressable market is $43 billion. So that's the opportunity for this company. And their revenue is about $8 billion. So 8 over 43 is close to 1 over 5. So they have about 18-19% of the TAM. They break down the $43 billion into these 6 groups. Energy infrastructure, $8 billion. Charging, $1.1 billion. Factory automation, $9 billion. EV, $16 billion. Advanced safety, $6 billion. $4 billion in 5G cloud power. Their semiconductor chips go into 500 places on an EV. All these circles are where their chips go into. They have an extensive customer base: Dell, Sony, Panasonic, Microsoft, Vallejo, Ericsson. Their top 20 customers represent 40% of revenue, and each customer buys 600 products on average. Their 2023 revenue is $8.25 billion, and they project a 10 to 12% CAGR, compound annual growth rate, through 2027. Gross margin from 47% to 53%, OPEX from 14.8% to 13%. They plan to invest in R&D for long-term growth. Operating margin 32% to 40%. They plan to grow operating income faster than revenue. CapEx 19% to 11%. They say a high return on invested capital for their brownfield investments. A brownfield investment is when you invest in a manufacturing facility that's already in use in another country. If it said greenfield investment, that means they would build their own manufacturing facility. Brownfield is investing in a pre-existing facility. But brownfield and greenfield are ways to describe investing in a foreign place. Free cash flow jumping from 5% to 25 to 30%, returning 50% to shareholders. Revenue is flat from 22 to 23, $1.9 billion in the first quarter, $1.7 billion projection next quarter, and a 10 to 12% CAGR through 2027. Gross margins are getting worse, 49% down to 47%, down to 46% in the first quarter, and they project 45% for the second quarter. Look how low their free cash flow is getting. It was 20% down to 5%. It is up to 7% in the first quarter. No projection for the second quarter. But the target for 2027 is 25 to 30%. Let's look at the stock on Simply Wall Street. Its last price, $70, $30 billion market cap. Down 3% in the past week, down 33% in the past year. It looks like the stock never split, so it'll be easy to look at a chart. It IPO'd in 2000 at 25. It looks like people thought the company was going to go bankrupt because it fell to $1 the following year. For the next 12 or 13 years, the stock did pretty much nothing. So if you got it at IPO, you had to wait 20 years to get your money back. And they didn't pay a dividend. But finally, 2 decades after IPO, the stock moves up. In March 2020, it went from $10 over $100. It went up nearly 1,000%. From July 2023 to October 2023, the stock went down close to 50%. It also got pretty low in April 2024. The stock does move around a lot. Do you think it's a good long-term investment? I think so. I'm not 100% behind this company. There is a lot of competition in the semiconductor space. Simply Wall Street thinks they're undervalued. Their price is $114. 27 analysts priced this stock at $83. Their revenue peaked in 2023 to $8.3 billion, and the forecast for 2025 is $8 billion, 2026 $8.9 billion, a new record if they hit it. And they're investing a lot into CapEx. If the investment pays off, free cash flow should be $1.7 billion this year, growing to $1.8 billion in 2026. Their debt was under $1 billion in 2013. It peaked at close to $5 billion in 2020. They have paid down some of the debt, Now it's $3.3 billion. Equity and debt were real close up through 2020, but in the past 3.5 years, their equity has continued to grow while their debt stabilized. So now they have a pretty good debt to equity ratio. They do have a lot of cash on their balance sheet, almost the same amount as their debt. $2.6 billion of cash, $3.3 billion of debt. The CEO was paid $36K in 2020, a big raise to $950K in 2021. Now it's $1.1 million. Total compensation, $20 million, tenure as CEO, 3.6 years. In the past year, only insider selling, no buying. 98% of the company is owned by institutions, 1.5% by the general public. Fidelity is the biggest shareholder at 13%, then Vanguard, BlackRock, State Street. Geode owns 2.3%. The San Francisco investment firm Artisan owns 1.7%. The Norwegian bank Norges 1.1%. Rafferty, a subsidiary of Direction, owns 1%. First Trust Advisors, 0.8%. They employ a good amount of people. It was 22,000, now it's 30,000. The ticker trades on the Nasdaq, Deutsche Börse, Zicha, London Stock Exchange, Mexican Bolsa, Wiener Börse, and Sao Paulo Bolsa. On has 60 reviews on Glassdoor. Let's see what the employees say. The average rating is 3.6, which is decent, a little low. The first review is a 5 out of 5. The team I worked on was very inclusive. No ego whatsoever, despite very impressive backgrounds. Genuine, felt like a family there. No con. The next one is 3 out of 5, an inventory planner. Work and life balance was good here, as was the pay. Cons, organizational problems related to spending and other expenses required hundreds to be laid off. The next one, 2 out of 5. Pros, stock options, employee stock purchase plan, and the people. Cons, micromanagement, number of checklists, and lack of accountability. Micromanagement, that is a nightmare if you have to deal with a micromanager. You bring that stress home with you, it never goes away. The next is a 4 out of 5. Great pay and benefits, good working environment. Cons, they grew too much too fast, resulting in layoffs. Again with the layoffs. The pros, 12-hour shifts, 3 days/nights 1 week, 4 days/nights 1 week. Easy workload. Cons, bad management, favoritism, discrimination. Merit increases depend on supervisor likes/dislikes. Unfortunately, that's everywhere. If you're well liked, you tend to get raises and promotion, even if you're not doing the best job. Overall, not impressed. I would say the pay, decent. I think he meant is decent. The cons, cheap company and cheap labor. Here's a 1 out of 5, taken a nosedive in the past few years. It's a current employee. Pros, some great team members still exist. You are lucky if you can work with at least one. Some of our teams have been cut down to one person through attrition and RIFs. RIF is reduction in force. That's a corporate term. It's a permanent termination of employees. But the workload has exploded. Unfavorable news and shareholder suits are embarrassing. Advice to management, you need to invest in your people who do the bulk of the work. It might change the bottom line slightly, but not being able to make product or support regulations, laws, and customers will make a bigger difference. The working environment is great as people treat each other with dignity and respect. Cons, stressful, but can still say that it was fun. Was once a stable company with a healthy, supportive company culture. Pros, the semiconductor industry is booming. Given that, the company is doing well in spite of grave mistakes by its new leadership. Cons, the former executives and management teams were ousted and replaced by less experienced leadership that views its employees as disposable, seeks to boost gross margin at all costs. Well, that's not really working when we looked at the financials earlier. And has steadily gutted key functions like finance and IT through layoffs and attrition. Advice to management, make the company a stable place again for your employees to grow a long, productive career instead of short-term stopover for recent engineering grads to gain a few years of experience before moving on to a healthier working environment. Unethical, no pros. Liars and unjust treatment. They legit allow racism and sexism. Ouch, that's pretty harsh. This is a former employee in New Hampshire. Cons: allowed physical altercations and allowed the N-word to be thrown around. The N-word at a semiconductor company, you don't say NVIDIA when you're working at On Semiconductor. Do not use the N-word. They allow supervisors to steal time and money, making their products cost so much. Advice to management: stand by your rules and regulations. A retired engineer. The pros: management direction has improved in the last 2 years. Cons: low salary area, nearly insane schedules, driving bad employee/management behavior. The advice for management is to aim for less chaos and rational schedules. House of cards. The pay is decent and it is a steady job. The benefits and PTO are not very good. Advancement opportunities are very lacking. It's not just lacking, it's very lacking. They need to get rid of the old legacy managers from IBM and bring in some new and younger faces. Many of these managers get away with such poor performance and high turnover. Look at this, cheapest company in the industry. Pros: none, not impressed with the company at all. And this is a current employee. Cons: cheapest company in the semiconductor industry in every way imaginable. The pay does not match the roles. Every company thinks they're the cheapest company. I remember when we merged with another company, everybody at our current company complained how much the other company was making. And everybody at the other company complained how much we were making. Because everybody feels they're underpaid. A former treasury analyst who was at the company for more than 8 years. Pros: optimistic company outlook and diverse workforce. Cons: no career growth, not so much on gender diversity, lacking programs for employee benefits and welfare. 3,800 comments on Yahoo Finance. Let's read some of them. On has doubled in 1 year. With all the new revenue sources and relationships announced in the past week, I see a solid add to my position. Only 600 shares, but it seems like a solid future big win, even at current pricing. Just my humble opinion, but the data is available, probably not for short-term traders. According to Benzinga Pro, On Semiconductor short interest grew from 3.3% to 9% since their last earnings release. A low PE and reasonable PEG, strong profit and operating margins, very solid earnings, reasonable debt to equity ratio. Do not get distracted by their earnings report. In the last 2 weeks, On has announced 3 supply agreements with major companies representing several $billion. The all-time high will be in the rear-view mirror when the forward predictions are revealed after the quarter numbers are reported. Verify this for yourself. It is available. Somebody responded to that comment: you still keep it as a long-term position? The Tesla Investor Day is causing quite the stir. There are few details, but there was a comment that Tesla plans to use 75% less SiC in its next powertrain. SiC is silicon carbide. SiC is used in the manufacturing of grinding wheels, cutting tools, and sandpaper. Silicon carbide abrasives are usually cheaper than other alternatives. The abrasives are used to grind materials such as steel, aluminum, cast iron, and rubber. I added On today. EV is a mega trend. On will be back to a new high later. EV has been really lacking. We thought it was the hot new thing, but even Tesla is struggling with sales. I think EV cars will always be around for the rest of our lives, but I don't think it's going to take over as much as we thought. All the negative sentiment about slumping EV sales at US auto dealers, which appears to be bottoming this past quarter for EVs versus hybrids. Their price target lowered to 105 from 130 at B of A today. This post is about 9-10 months old, so the stock is now down to 70. Another big part of the Morgan Stanley call was if silicon carbide provides 10 to 15% efficiency. That means the battery can be 10 to 15% smaller, which is the biggest cost of an EV. EV will be cheaper than ICE by 2027, no way. Plus, they get a credit on top of that. On Semi fastest 2023 growth of silicon carbide. Get in, a lot of great info on the call. Lots of buzz regarding CHIPS Act money flowing. BAE in New Hampshire was first today. I can't read this review. Too many grammatical errors. This morning, Kramer was talking about automotive as being the last component of chips to roll over. Said STM said bad things about auto. They didn't. Let's read some older reviews. It's more interesting because we have perspective. We know what the future is when the person wrote this review. Anyone looking to buy options before next Monday? ON is increasing its margins quickly. Last year, its EBITDA margin was 20.5%. By the end of 2023, the expectation is 30.6%. Sold short ON at $39, with a lot of shares as a pure earnings play to hold through her earnings release on Monday. I am looking to cover my ON pure earnings short sell at the 37.50 level anytime today, including pre-market before her 8 a.m. ET earnings release. ON is bid up here in the pre-market on very thin volume, but let's wait until the 9 a.m. conference call. Whoops, looks like this might be open the day at under 39. Collapse. This is why I love to sell short on pure earnings, folks. It works. Holding my buy cover at 37.50, not going to get too greedy on this one. And suddenly we are full of bearish sentiment comments from users that appear here for the first time. I got the message, I'll start buying. Far from an expert, but the sector appears primed to go parabolic. Great buying opportunity, in my opinion. Good luck to all. Added more at 37.57. Most of tech shares were moving in the same pattern. Dump before a strong uptrend, regardless of Q1 results. Look at Form, Himax, UMC, AMD. These will be the next up, maybe next week. Down another $1, I am out of this. Beep, beep, beep. Lost too much money. You can talk about good margins, etc., but there is something else wrong. It is not my job to figure it out, it is management's job. Apparently, they have no clue. The US is close to announcing the $52 billion CHIPS funding deal. This could be a huge boost to ON. So if Taiwan shuts down, Katie bar the door? ON is very undervalued and trading around 3x sales. Its competitors like NXPI and Marvell are trading around 5 to 6 times sales. Is ON the secret supplier for SAV to Elon Musk? Is SAV sports activity vehicle? Maybe stock at valuation? Maybe it's self-adhesive vinyl. How about shared autonomous vehicle? State audit of Vietnam. Sorry, anti-vaxxer. I think I beat that dead horse. If ON was bought out, what do you think the SP then would be? The price target raised to 48 from 46 at Susquehanna. The analyst said his confidence in the company's successful turnaround continued to grow as management's tone during their meetings was upbeat. Wake up, ON! It has not recovered from February 2021. Can someone explain why it doesn't join the current trend? I think this will run up to earnings. Bought 300 for the first time. We see. STM had a great earnings release. Here's STM stock. It doubled in 5 years from 17 to 34. This comment was written in July 2021. So in July it was trading at 41. So it is lower from that point. Electric self-driving autos is in the future. $50 soon. On beat in last 3 quarters. Another big beat this coming Monday. Good luck to all. I am surprised it didn't get bought out. VNE got bought out by Magna. They provide automotive technology, and they were acquired by Magna. Magna International is a Canadian automotive company. They have a $12.5 billion market cap, trading at $44. You can buy them in the United States or on the TSX. They pay a pretty good dividend, 4.4%. Looking good today, nice ER. Upgrades coming soon. To the moon. Never buy peak. Curious, anyone know if this got any coverage on CNBC yet? I don't know who is on Power Lunch today, but maybe they will talk about it then. I should have added more on the recent pullback, but happy with this move today. New target $60. 17 million short shares have to be covered. ON will be at least double or triple. New price target $60. New price target 51. Tesla is meme stock, just like GME. That is shame because it is a great EV company and completely hijacked by the cult. $100 it should be. How about that? ON is kicking ass just like I predicted. Shorts running for cover. Short squeeze coming, and that right soon. Imagine the short squeeze that is going to take place here, 100 soon. Wait until Reddit catches on here. Oh boy. This stock is very desirable at 44, easily headed to 50 by the end of the week. Boom. Chart says this is a spike. ON Semiconductor CEO to be on Mad Money today. High alert, huge upgrades for ON. Buy more. Zacks upgrade to strong buy for On Semiconductor analyst ratings history. Buy more shares on this bargain dip today. For a great return, even tomorrow, $50 up. Just bought great bargain price for 8,700 shares. Strong buy by Zacks. Do you guys like Zacks? I never really used it. I should check it out. Price target raised to 53. Just like MVIS for Microsoft is the same as On for Tesla. Buy them and forget about them for 3 years and become very rich. That's the end of the video. Thanks for watching. Leave a comment. Talk to you soon.